Joining me now are Adam Posen, president of the Peterson Institute for International Economics, and Barry Knapp, director of research at Ironside. CNBC senior economics reporter Steve Leisman is with us. Steve, you're not here on set with me. Where's Waldo?
I'm sorry. I'm in what Dick Cheney used to call a UDL. Undisclosed
location. Okay. Well, please feel free to jump in as needed throughout this discussion. And Adam, I'll turn to you because you have a forecast for 2 mega cuts later this year. Then you think we'll be back to hikes by next year. So how exactly do you see this whole economic situation playing out?
I think we're on our way to inflation, whether we get recession or expansion, Kelly. I think there's a 2/3 chance we're going to have negative growth on average over the next 6 quarters. In which case the Fed will panic and cut rates, but they will wait until there's been some shakeout from the fiscal policies and the tax and tariff policies. But I also think you're going to get inflation whether or not we get growth. And so the Fed is going to cut as a matter of forecasting, but it's going to be a mistake. And they're just going to have to start hiking rates in 2026.
So you see both the slowdown and inflation. So we're going to hear a lot about stagflation. And the prior experience in the 70s, these rates were many times higher than what they are now. But do you still think the use of that term would be appropriate?
I think in the literal sense, it's appropriate in the sense that normally you do not have, except for a month or so, coincidence of declining employment and rising inflation. But I also think it's important because even though, God willing, it won't be anything like the 70s, it is the similar dilemma for the Fed as it was in 79, that you have to make a hard choice, as Chair Powell, I think, articulated reasonably well last week in Chicago.
I'm curious that you and Barry both agree that the economy is going to slow. But, Barry, you're much more dovish. I mean, you see a lot more disinflation coming, I think. Do tell.
I guess I would start with a little bit of a caveat. I never really thought we were going back to below Fed target inflation through this entire business cycle. I do think, though, there are a couple of major disinflationary forces in place. Last week, the Fed released the new tenant index. It's been decidedly negative 2 quarters in a row, so that's going to put downward pressure on rents. I'm not sure that's sustainable through the rest of the business cycle because of the collapse in multifamily construction. But for now, we've got this inflation there. I think if Congress does follow through on spending cuts, that could put somewhat downward pressure on non-housing services inflation. And import prices were starting to cool before the trade surplus penalty tariffs, I refuse to call reciprocal, hit. And so China still has that excess capacity. They have 2.5% negative PPI manufacturing capacity. So I'm not as worried about inflation as Adam is, but at least in the near term. But I am clearly worried about growth. And I would note, in addition to the Philly Fed non-manufacturing survey you mentioned, we had Richmond Fed manufacturing and services today. The business capital spending plans 6 months forward have absolutely cratered. Jan Hatzius cited that today as a reason why the Fed really can't wait until they see themselves starting to fail on the employment part of the mandate, or wait for capital spending to get even weaker than it was in the second half of last year. So I think they'll probably move sooner than Adam said, but nonetheless, I think they are going to end up moving.